Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Lauren Romeo, manager of the Royce US Smaller Companies Fund, which features on our wealth shortlist of funds selected for their performance potential. So Lauren, with the Royce US Smaller Companies Fund, you can invest in thousands of companies from all across America. How do you narrow that down into the portfolio you have today?
We have an approach that is trying to invest at the intersection of quality and value. And so we apply some key quality metrics, such as companies that have generated high returns on invested capital, have strong balance sheets, and have good free cash flow generation. And we use those as an initial screen to really winnow down that large universe to the types of companies that have the business attributes that we're looking to invest in for our company.
Investors have seen the US market become increasingly concentrated at the larger cap end. Is now the time to look at smaller companies?
We believe it's an extremely attractive time to look at smaller companies. You've seen large cap has been in a essentially 12-year outperformance period relative to small caps, and small and large have typically traded off leadership in the market over time, and average cycles have been about a decade. So we're already into year 12, and what's interesting is when you look at when past large cap cycles have peaked, it's been at a point when concentration within the S&P 500 has been extremely high. So, and currently, if you look at the top 5 stocks in the S&P 500, they represent about 28% of the index, which is an all-time high. And so if past is any example, it's just another sign that we're getting to the top in terms of large caps. I'd also say, but more important from a fundamental standpoint is if you look at small cap valuations on an absolute basis are reasonable, a modest premium to where they've sold historically, whereas large cap is at about a 32% premium to its long-term average. And then if you look relative, small caps are at an extreme discount to where they trade on a relative basis to large caps, and it's at a 25-year low. The last time we've seen this type of discrepancy was back in the dot-com bubble in the US. And then lastly, so you've got a valuation case, then what's interesting is that in 2025, small caps have been in a sort of a 2-year earnings recession, whereas large caps have generated modest earnings growth. This in 2025 and going forward, you're starting to the estimates for small cap earnings growth are significantly higher, almost 3 times as high as what the growth outlook is for large caps. And that's something that had been missing in the past. You had the valuation case, but now you have a potential catalyst in much faster earnings growth. So I think as people look and see that they can buy high quality companies at very reasonable valuations relative to what you see in the large cap universe, that combination of valuation plus accelerating earnings growth makes a great case for small caps.
And you mentioned quality is an important focus for you, but 40% of US smaller companies are actually loss-making. So is this a part of the market where investors need to be investing actively rather than passively?
Absolutely. I think it's something that's underappreciated, that the Russell 2000 index has declined in quality over the years, and so at where we are now is a peak for a non-recession period. And so yes, we think if you're going to invest in the large cap, in the small cap space, it makes you want to go with active management so that you are having exposure to quality companies, because quality historically over the life of small caps, it's the quality cohort within small cap that has always led performance. And so that's why you want to stick with quality, and buying the index won't get you that full impact.
And Trump has now started his second term. Do you think his presidency is likely to be a tailwind or a headwind for smaller companies?
Currently, it's a little bit of a headwind. The constant headlines that contradict what we heard an hour earlier are obviously causing a lot of uncertainty, and the market hates uncertainty. And so we've seen volatility increase, and we've seen a lot more. We've started to see sell-offs, but so near term, it's creating that sort of headwind and a pause. A common theme we're hearing from companies that we speak with is we're back to this sort of wait and see moment. It's like we were ready to go forward with investment, but now in a new factory, but let's wait and see how this tariff situation plays out. So it could have a near-term sort of pausing effect. At the same time, from a stock picking standpoint, we're actually, it's actually a good thing in the sense that the volatility has definitely increased. But we, as small cap investors, we actually like volatility because it creates real opportunities to be able to buy quality companies when they're trading out of favor for what we think are either the market's misunderstanding, or it's indiscriminate selling, or it's a temporary problem that we think is fixable over the long term. And so that those volatility moments when you have those kind of downdrafts where people are selling on the headlines and figuring out the facts later, that gives us a great chance to buy high quality companies at reasonable valuations.
And you've spent your career invested in US equities. Thinking back to when you started out, what's something you sort of picked up along the way that would have been useful to know back then?
I was very fortunate in that my first job in this business was with an investment management firm led by two men who were devotees of Warren Buffett and this business buyer's approach to investing. And so that was instilled in me at my first job, and it was really really instrumental in terms of it just clicked with me. It made sense. I had read a lot of books on different styles of investing, and this was the first one that really stuck with me. I was able to kind of delve into that type of the type of due diligence that's required to do this sort of business buyer's approach to investing, and most importantly, it puts you in the right mindset of how you should look at it. I mean, we're not looking at stocks as pieces of paper or now electronic tickers that we're just trading every couple hours. It's really taking an approach of saying, okay, this is a business. Do I want to own, put significant capital in this business and own it for the next 10 years, assuming the stock market was closed? And so it puts you in that perspective of, okay, I've got to look back, not at, okay, what's next week's employment report going to be, and what's that going to do to my stock? I'm less concerned about that. I'm focused on, what are the economics of the business? What is the company's competitive advantages? Are they able to earn returns well above their cost of capital so that they're creating value? And equally important, are they able to sustain those returns? Looking at the competitive landscape and disruptive technologies that might be coming. And then looking at, related to that is sort of the free cash flow that's generated and the reinvestment opportunities that management has, and those two combine together to give you what the growth rate is of that company long term. And so those ultimately, over the long term, those are really what determines the value of a company in the stock market. And so that type of business buyer's approach, really learning that early on, and then working for subsequent managers, and particularly the last 20 years with Chuck Royce, has been just hugely impactful and influential in terms of having high conviction in the investment approach that we take, and being part of a firm that has time-tested results following this strategy.
And who would you say has had the biggest impact on you as an investor?
Again, I'd probably have to go to Chuck Royce for sure. Amazing individual, pioneer in small cap investing, and incredibly smart and able to really narrow down what the key issues are on a company from the economics of the business standpoint in like 5 minutes. And so that's been great to kind of learn to cut through the noise and focus on what matters. I worked for Bill Miller at Legg Mason several years ago, and he was tremendously influential as well in terms of he has that business buyer's approach, but also, always being, not just accepting what the market is saying and making sure you're testing your assumptions, and because a lot of times the market, everybody assumes the market is efficient, but I think it's actually in the near term it's actually kind of inefficient, and so always testing your not just accepting and being always questioning and taking the sort of a devil's advocate view, and not being afraid to be, if you particularly with Bill, not being afraid of the courage of your convictions. And as I said, the first firm I worked for out of college, the two gentlemen who ran that, again, just sort of grounding me in the Warren Buffett approach, and the analyzing companies as analyzing stocks as businesses, not things to be traded.
And outside of work, how do you switch off?
Well, this is going to sound very geeky, but I'm getting paid to do what my hobby is in a way, so I'm very fortunate. I love what I do, and so if I were not in this business, I'd be doing, I'd be reading stock, I'd be reading The Economist when it comes out on Thursday night electronically, and so part of me would still be doing what I'm doing. But yeah, there are, I think it's important to switch off, and so for me, I love going for a nice run or a brisk walk, particularly by the river near where I live, and it really just helps clear my mind and just kind of get perspective again.
Great, Lauren, thank you for joining us.
Thanks so much for having me, Joe.